We were taught that diversification is the only free lunch in investing, and it's been a free lunch that's given investors indigestion for the last decade, right? So we stopped doing it. I think we have to go back to that free lunch and say, now we have something, a gift in our hand that we need to take advantage of. And this diversification matters across everything. It matters across countries, across regions, across sectors, across styles, factors, everything. And I think investors really need to lean into this because just as we've seen over the course of the last year, diversification has the ability maybe even to enhance returns and reduce volatility.
Welcome to Well Said, a podcast featuring discussions with Wellington Management's top investment and research professionals. The market, macro, and geopolitical dynamics affecting investor outcomes are likely top of your mind, and they're certainly top of ours. I'm your host, Thomas Mucha, Wellington's geopolitical strategist and member of the firm's global investment strategist team. The concept of U.S. exceptionalism is based on an 80-year history of U.S. economic, geopolitical, and military dominance that's driven dollar primacy, powered U.S. financial markets, and for the most part, supported global stability. Now, while most of these dynamics still hold, it's also true that the world and the U.S. face growing turbulence in many forms, expanding regional conflicts, economic instability, and waning policy cohesion. The effects of this emerging dichotomy on capital markets are beginning to take shape, and asset allocators need to understand what the two truths of U.S. exceptionalism, namely it still holds and it's waning, may mean for them. So to help me break down all of this are close colleagues of mine who happen to be two of Wellington's most experienced and prolific market watchers, Nanette Abuhoff Jacobson, a multi-asset strategist, and Andy Heiskell, our chief equity strategist. Nanette, Andy, welcome to you both, and thanks for being here on the Well Said podcast.
Thank you, Thomas. It's a pleasure to be here.
Yeah, thanks for having us.
All right, Nanette, let's start with you and our favorite topic, the big picture. So as I said in my intro, as a team, we've argued that U.S. exceptionalism is both intact and waning at the same time. So from your perspective, what does that paradox mean for asset allocators who are trying to set strategic weights over the next, let's say, 5 to 10 years?
Thanks so much, Thomas, for the question. And it's sort of an existential question, I would say. And I really have keyed into Mark Carney's speech at the World Economic Forum. And he basically warned countries to become more independent in terms of their supply chains and also in terms of their military, preserving sovereignty, et cetera. So it was a call to action. And I interpreted that as a call to action for allocators as well, to hedge their portfolio to some extent based on the idea that there would be some decline in U.S. exceptionalism. Now, we have to certainly acknowledge that at this moment, we're in a Middle East conflict, and U.S. exceptionalism has in many ways reasserted itself. The dollar is up, gold is actually down, and U.S. equities are outperforming. So I would say that for the long term, you do have to keep these two truths in sight. For waning U.S. exceptionalism, I do think that having allocations to non-U.S. equities, and particularly emerging markets, is one of the areas that needs to be looked at and needs to possibly evolve. The second thing is that we've been asserting that inflation could be higher and stickier in the next 5 to 10 years for assorted reasons. If allocators think that U.S. exceptionalism will stay intact, we certainly believe that there are areas of the U.S. market that you may want to keep in your portfolio. Certainly U.S. equities in particular, we think artificial intelligence and the technology revolution that we're in is something to emphasize. And then for either scenario, you want to have exposure to active management where you can take advantage of the volatility and dispersion that we're seeing more frequently in the markets, and also more specifically multi-sector hedge funds These are all seeking to take advantage of dispersion in stocks and sectors. And within fixed income, I know we'll talk about this more, since fixed income is less reliable a hedge for equities when they sell off, we really are thinking more about dynamic fixed income strategies that can move their duration, move their sectors around, and be more tactical as this new world evolves.
I keyed into that Mark Carney speech as well. When it's coming from your most traditional long-term ally who sits on your northern border, that really resonated with me as well. So Andy, honing in on your area of expertise, markets continue to price the U.S. as structurally advantaged, especially in equities. So at what point do elevated valuations stop being a sign of durable advantage and start becoming a source of portfolio risk, the valuation question?
Thanks again for having me along. I guess I keep coming back to the happiness equation where satisfaction equals outcomes minus expectations. And U.S. equities have been truly exceptional the last decade plus, really since the financial crisis, because the outcomes have continued to exceed expectations. And if we roll back the clock, it's hard to imagine, but in 2011, U.S. equities troughed at 11 times forward price to earnings multiple. Today, they're around 19 times after the sell-off in the market, but not that long ago, they were 23 times forward earnings. So you had a near doubling of the PE multiple of U.S. equities. Very well supported, though, by fundamentals, where U.S. corporations were driving exceptional profit growth and beyond that, exceptional free cash flow growth. And so we're really demanding a higher valuation for that exceptional growth and profitability and the free cash flow. Well, where does that become a problem? It becomes a problem if expectations get too high. And what does a high PE multiple mean? It means there's expectations around future growth prospects as well as the durability of that growth. And what we just heard from Nanette, I think, raises a very fair question around both of those. That the starting point of valuations is hard to replicate what we had 15 years ago. And all of these questions that are arising around the role of the U.S. in the global economy, the volatility that's been introduced, I think draws into question around those future prospects of growth and the certainty and volatility around that, which does mean that starting point of valuation becomes a potential double-edged sword at this point.
So Andy, U.S. equity exceptionalism has increasingly been driven by, let's say, a narrow set of large capital-light tech firms. So how should allocators think about concentration risk when the same companies dominate equity benchmarks, earnings growth, innovation spending, and all the other factors that we look at?
Okay. Let's level set some of the facts today. There's more ETFs in the United States than there are listed companies. The traditional premise of passive investing was low cost, buy and hold, diversification. Most of these ETFs today are certainly not buy and hold. Many of them aren't even low cost, and many of them are certainly not diversified. And even if you say, well, the S&P 500 itself, okay, yes, you can have exposure to the S&P 500 in a low-cost fashion, and you can buy and hold that. But the index itself is no longer diversified, right? With tech, nearly 40% of the index, tech at large with AI included, well over half of the index today. And so I think we need to draw a very distinctive differentiation between passive investing and passive decision-making. And I don't think there's any passive decision-making in markets today. And just let's think of a simple example of this. You can own the S&P 500 cheaply, efficiently in two easy forms. You can own the index in its index weight, or you can own the S&P 500 equal weighted. There's ETFs that exist for both, same cost for both. The composition of those are the same underlying 500 securities. But because of the weights being so different, the outcome that you get as an investor in those is a very, very different outcome. So which one do you own? That is an active decision. Now, you can express that maybe in a passive vehicle. But I think that we're in this moment of time, given the concentration within the U.S. market, given the concentration of U.S. within global equity markets, now U.S. 2/3 of global equity market cap, that there's very active decisions that allocators are making all across the board. Now, they might, again, think they're expressing that in a passive form. Yes, they are, but that's a very active decision, and we have to be very cognizant around what risks that introduces into our portfolios.
So, Nanette, let's pull the lens out a little bit farther here. So, U.S. fiscal sustainability is becoming harder to ignore, even as growth remains relatively strong. So when do fiscal and debt dynamics move from a background concern to a first-order asset allocation input And I mean this across equities, rates, and currencies. This is a question that I get from clients all the time, by the way. So give me a good answer.
Yes, sure. I'll give you a good answer. So let's just level set. The U.S. fiscal deficit, primary deficit, is about 7% of GDP. That is the 100th percentile relative to developed market deficits. So we're running at huge levels of debt. And if you want to put that from a public debt percentage, we're at around 100% debt GDP. That is the highest it's been since World War II. And so, clearly, and I think this is probably a question I get all the time from clients, is when does that become an issue? And I would argue it has already become an issue. And we've seen that most notably in the UK. Everyone remembers the Truss moment when Prime Minister Truss was in that position for all of 3 minutes. But she had announced basically a series of tax cuts which were not funded. And so the market revolted at that. And the bond market soared in response to basically fiscal irresponsibility. So we've seen examples of that in the United States as well. We've seen it in France. UK is certainly most sensitive to that. This is the term premium that many market participants talk about. And that term premium right now is rather low in the United States. So the question is, when does it become recognized? And I would argue that the decline that we saw of about 10% of the dollar in 2025 is reflective of concern about fiscal sustainability in the U.S. And what's the problem? From an economic standpoint, our interest expense is as large as the U.S. defense budget. So when you're talking about numbers that size, obviously the economic impact is that money can't go to productive uses. It has to go to pay our debt down, which I think is a problem, right, for the economy and society. And so where do I see this really showing up? I think it will show up in episodic periods of higher interest rates, particularly at the long end. I do think that we are in a secular decline in the dollar, even though this year the dollar is up, as I mentioned earlier. We are in a really unique situation, geopolitically speaking, but the direction of travel is weaker for the dollar. So that's how I expect it to show up in markets.
What signposts would you look for a trust moment here in the United States?
Well, I think the next phase of fiscal spending is going to be scrutinized by the market. And will it be because of high gas prices? Will there be direct handouts? Something like that, I think, would probably be a catalyst for rates to go higher. So those are the two. Most real-time indicators will be rates and FX. But anything that really looks like direct handouts is going to be a pressure for the market.
Nanette, you mentioned the dollar, and the question of the dollar as reserve currency around the world comes up a lot in my geopolitical conversations.